Welcome to today's webcast. I'm Jeff Rogers. I'm a tax partner at Feeley Driscoll. We'll be discussing 2013 tax law changes. I'm going to go through some of the major tax changes that have been signed into law over the last couple of years that could have a major effect on your 2013 taxes. A year ago at this time, everything was in a state of uncertainty. The country was headed toward a period that was being referred to as the fiscal cliff. Without congressional action, there were a series of previously enacted laws that were set to all go into effect on the 1st of January. When taken together, the expectation was they were going to have a crippling effect on the economy and could quite possibly result in a recession. On the tax side, the Bush tax cuts of 2001 were set to expire. They had already been extended once at the end of 2010 for a 2-year period. The expiration of these tax cuts was going to result in higher tax rates. The 33% tax bracket will now be taxed at 36%. And the highest tax bracket in effect was going to return to 39.6% as opposed to 35% where it had been for the previous 10 years. In addition, the preferential tax rates that investors had enjoyed on their long-term capital gains and qualified dividends were set to increase as well. The alternative minimum tax was set to revert to its 2000 level, and the result of that would have been that an additional 20 million taxpayers were going to be subject to the tax. There was a payroll tax holiday which had reduced the Social Security tax liability of employees by 2%, and that was scheduled to expire at the end of the year as well. Ultimately, that tax did expire. And a couple of new taxes that were previously introduced as part of the Patient Protection and Affordable Care Act and the Health Care and Education Reconciliation Act of 2010 were set to go into effect. These bills have often been referred to as just the Health Care Act. When these bills were passed in March 2010, the goal was to increase the quality and affordability of health insurance for everyone, to lower the uninsured rate, and to in general reduce the cost of health care. Outside of tax, across-the-board spending cuts to many discretionary programs were set to take effect, and federal unemployment benefits were also set to expire. Fortunately, after much back and forth, lawmakers were eventually able to reach an agreement at the last minute, and on January 2, 2013, the American Taxpayer Relief Act of 2012 was passed. The major result of the American Taxpayer Relief Act was that the Bush tax cuts did in fact expire, but only for individual taxpayers that made more than $400,000 of income, $450,000 if they were married. All other tax brackets remained where they had been in previous years, just adjusted for inflation. President Obama had been advocating for the Bush tax cuts to expire for individual taxpayers earning $200,000 and married taxpayers earning $250,000, whereas Republicans were looking for the cuts to expire at a much higher level, around $1 million. Ultimately, the parties compromised at $400,000 single and $450,000 married filing jointly. Another key provision of the American Taxpayer Relief Act was that long-term capital gain and qualified dividend tax rates were going to be increased from 15 to 20% for taxpayers that fell into that same $400,000 single, $450,000 married taxable income range. On the positive side of things, a permanent AMT patch that allowed millions of taxpayers to avoid the alternative minimum tax and went into effect, and it brought the AMT back more in line with its original intent, although not nearly as close as it should be. The estate and gift tax rate was set at a maximum 40% tax rate. Many of the business and individual tax incentives that had been set to expire, such as the bonus appreciation that allows companies to write off 50% of the cost of fixed assets in the first year, were also extended. One other aspect of the act that flew under the radar was the reenactment of the P's limitation and the personal exemption phase-out. As far as the personal exemption phase-out is concerned, every taxpayer is entitled to a $3,900 exemption for themselves and each of their dependents. A married couple with 3 dependent children would have a $19,500 exemption to be used to reduce their taxable income. Beginning in 2013, the benefit of these exemptions phased out, beginning with adjusted gross income of $250,000, $300,000 married filing jointly. The entire benefit of the exemption is eliminated once AGI reaches $372,500. That would be $422,500 married filing jointly. So what would have been a $7,722 tax savings for a married couple in the 39.6% tax bracket is now off the table. The P's limitation, which which is named after the congressman that introduced it, is a bit more complicated. It is a limitation on the value of itemized deductions. What the P's limitation aims to do is limit the value of your itemized deductions. It would be mortgage interest expense, real estate or state income taxes, charitable deductions, by 3% of AGI once AGI hits $250,000 for an individual taxpayer, $300,000 for a joint taxpayer. These are the same thresholds as for the personal exemption limitation. In no circumstance, however, can you lose the benefit of more than 80% of your itemized deductions. Looking at this example, we have a married couple with an adjusted gross income of $670,000, so they're well into the 39.6% tax bracket, and they're $370,000 beyond the point, $300,000, where full benefit would have been received for those itemized deductions. 3% of this excess $370,000 is $11,100. If they had $45,000 of itemized deductions for the year, rather than receiving the full benefit, they would only be able to deduct $33,900 of that amount. This cost this couple approximately $4,400 in taxes. The impact of this provision is more or less a 1% increase in the tax rate. So while 39.6% is the tax rate that is typically referred to as the highest tax rate in effect, the reality is that it is 40.6%, and that's without even considering the personal exemption phase-out. It should be known that neither of these phase-outs are new concepts. They were both around in the pre-Bush era and were among the cuts that he had put into effect. So moving on to the Patient Protection and Affordable Care Act, there were two very unique tax provisions that were added in. The first is a mandatory 0.9% Medicare tax on wages and self-employment earnings for individuals earning $200,000 and married couples earning $250,000. One thing that you may have noticed by now is that there is a lot of inconsistency related to where each provision kicks in. The 39.6% tax rate and the 20% qualified dividend long-term capital gain rate kick in at $400,000. The P's limitation and personal exemption phase-out begin at $250,000, and this additional 0.9% Medicare tax and the net investment income tax, which we will be discussing in a future presentation, kicks in at $200,000. This 0.9% Medicare tax is a tax over and above the Medicare tax that is currently in place. Through 2012, employees and self-employed individuals were subject to a 1.45% Medicare tax on their earnings. Their employer would have to match the 1.45%. So a total of 2.9% was being paid into the Medicare system. The self-employed individual would pick up the employer's share of the Medicare tax and would claim a deduction on his return just as an employer would. This 0.9% tax brings the overall Medicare rate up to 3.8%. It is an employee liability, not a liability of the employer. The employer does not match the withholdings. Therefore, there is no deduction that they're entitled to. The employer is required to withhold the tax from the employee's paycheck once their salary hits $200,000, regardless of their marital status. This lends itself to a couple of interesting scenarios. In the first scenario, you might have a married couple in which one spouse earns $225,000, but the other does not work. Since combined, they have less than the $250,000 of wages required of a married couple, they are actually not subject to the additional 0.9% Medicare tax. However, the employer had an obligation to withhold the extra Medicare once their employee's salary hit $200,000. The married couple will be able to get the extra withholding back when they file their 1040. There's a new form that has been introduced to accommodate this. Similarly, you could have a case where both husband and wife each earn $150,000, so $300,000 combined. This puts them $50,000 beyond the $250,000 threshold where the additional Medicare tax would apply. However, since neither of them earned $200,000, neither of their employees had to withhold the tax. They will have to make up for this shortfall when they file their personal tax return. Let's go through one example to reinforce how this works. Jim is a single taxpayer. He is self-employed and earned $500,000. Since $500,000 is $300,000 beyond the $200,000 earnings threshold, the 0.9% Medicare tax will be imposed on that excess $300,000. The result is $2,700 in additional Medicare tax. The other provision of the Patient Protection and Affordable Care Act is the 3.8% net investment income tax. This is an entirely new type of tax that was introduced as part of the bill, and it's imposed under Section 1411 of the Internal Revenue Code. This tax is a 3.8% surtax on net investment income of individuals, estates, and trusts. For individuals, the tax applies on the lesser of net investment income or the excess of their modified adjusted gross income over $200,000, $250,000 if they're married filing jointly. And worth noting there is that tax comes into effect based on an adjusted gross income threshold. Modified adjusted gross income is your adjusted gross income with a few exceptions. For all intents and purposes, it's your adjusted gross income. Typically, any other tax rate is imposed on your taxable income. This is different. This tax is imposed before considering itemized deductions. For estates and trusts, the tax applies on the lesser of the undistributed net investment income or the excess of the estate or trust adjusted gross income over the dollar amount in which the highest tax bracket begins for that particular year. And if in 2013, that's $11,950. We will be focused more in detail on this net investment income tax in a future webinar. We want to thank you for joining us for our 2013 tax law change webinar. Feeley Driscoll is a Boston-based regional accounting firm serving businesses and individuals throughout New England. Should you have any questions, please feel free to contact us at 888-875-9770 or visit us online at www.fdcpa.com. Thank you very much.